On the 2nd of February 2000, a couple thousand people packed into one of Tokyo's largest club venues called Velfare. The party was called BitStyle, a celebration of the booming internet revolution that promised to reshape the world far beyond anything in human history. And there was one man that the entire party was waiting to see: Masayoshi Son.
Masayoshi Son.
Masayoshi Son.
Masayoshi Son.
Here I am. I'm the richest guy in the world.
Masayoshi Son was the face of the dot-com boom, the emperor of the internet, according to Time magazine's 1999 piece. His net worth had skyrocketed in the span of a couple of years, and just 2 weeks after the BitStyle party, on the 15th of February 2000, he became the richest man in the world.
My net worth, personal net worth, was increasing $10 billion per week. For 3 days, I became richer than Bill Gates.
And then, without warning, it all came crashing down.
This closing bell might as well have been an alarm, so savage was the selling.
Not just a bad day on Wall Street, a record-setting bad day on Wall Street.
In a matter of months, Masayoshi Son's net worth collapsed by more than 90% and set a record for the most money lost by a single human in history. And the baffling details of how exactly it happened share eerie similarities to the tech revolution we're living through right now. Losing 90% of your net worth sounds insane, but the warning signs were sitting there right in the numbers. And that's why I use Investing Pro from investing.com. Their Investing Pro subscription is the one-stop shop for investors. I especially love their screening tool that lets you filter through extensive industry-grade data for thousands of global stocks. You have until the end of July to get an incredible 60% off, plus an extra 15% off just for my audience if you use code Hamish at checkout. So if you're serious about growing your money, don't sleep on this one.
America Online introduces new version 4.0.
If you have a phone line, you can be online.
It's the easiest way to keep up with old friends.
Everyone I know is on it.
We've spent over $1 billion to create a high-speed.
By late 1999, the dot-com craze was in full swing. This confusing new technology called the internet was going to change every business in every industry, and no one wanted to be left behind, the least of all investors. That year, more than 450 companies went public in America. One of them was VA Linux. It didn't generate much revenue and was certainly not profitable, but they were selling internet infrastructure, so obviously they were going to be much more profitable in a few years. It went public at a $1 billion valuation, and then proceeded to rise 700% in a single day, the biggest first-day performance of any IPO in history. But halfway around the world, something even more peculiar was happening. In October 1999, a crowd turned up at the Imperial Hotel in Tokyo to hear a presentation about a new stock exchange. Masayoshi Son had teamed up with the head of America's Nasdaq to build the Japanese version of the Nasdaq exchange. Son founded SoftBank in the early 80s, but what was once just a simple software distributor had been converted into an investment vehicle for him to buy up as much of the internet as possible. He spent the late 90s converting it into a holding company for internet businesses, a portfolio of stakes in the hottest names of the era. And he was doing a pretty good job of it, holding about 7 to 8% of the combined value of publicly traded internet companies by his own account. Forbes crowned him the master of the internet, and Son talked like that title was underselling it. He described a 300-year vision for SoftBank, comparing the internet revolution to the Meiji Restoration, the upheaval that ended feudal Japan. And he said he was building a society that people a millennium from now would remember. When Masayoshi had something to say about the internet, everybody stopped to listen. He has a clear vision of how technology is going to connect everyone globally in the next 50 years. One prediction at the core of his philosophy was that e-commerce would likely be fragmented, that lots of specialized niche websites would thrive. It would take enormous expertise for Amazon to win in every category. Do you think McDonald's could be #1 in hamburgers, seafood, and Chinese food? He told Forbes. One of the many bets he placed arose out of a meeting with a young, unknown Chinese entrepreneur. Son took just 6 minutes before agreeing to invest $20 million.
27. Warner back to throw.
The January 2000 Super Bowl was less a display of elite athleticism than it was of the unbridled .com mania.
OurBeginning.com. Life's an event. Announce it to the world.
The $2 million advertisement spots were dominated by internet companies.
It's time for E-Trade, the #1 place to invest online.
Computer.com. Computer stuff. Computer stuff explained. Sorry.
More than a dozen different firms bought airtime to draw in new customers and, more importantly, to drive everyday investors to buy their stock. $176 billion had poured in from retail investors in 1999, and no stock anywhere was soaking up more of that money quite like SoftBank. Through the last months of 1999 into February 2000, the share price climbed close to vertical. On the 15th of February 2000, SoftBank briefly touched 11,000 yen a share, making the company worth roughly 20 trillion yen, which is close to $200 billion US. It overtook Toyota as Japan's most valuable company and was among the biggest firms in the world. Son personally owned about 42% of it, meaning his slice was worth around $84 billion, and for a few days in the middle of February 2000, by his own account, was the richest man in the world. That same month, another Japanese founder was richer than ever before. Yasumitsu Shigeta, a mobile phone salesman, reached an astonishing $42 billion of net worth. Shares in his company, Hikari Sushin, were trading at 241,000 yen a share, about 720 times what it actually earned in profits. An eye-watering valuation under typical circumstances, but nothing unusual amidst the .com euphoria. The following month, March 2000, Hikari Sushin reported a $124 million loss, a figure that investors were promised would be a profit. The stock was absolutely obliterated. For 20 consecutive days, it hit the maximum daily decline that's allowed on the exchange. Within 3 months, the stock was down 90%. On the 10th of March 2000, the Nasdaq in New York peaked at 5,048 points, with the companies listed on it worth a combined $6.7 trillion. And from there, the entire .com sector started to slide.
In pointage terms, it has never been this messy, and it has never been this bad.
SoftBank went down with it, and it went down hard. The stock lost 75% of its value in 2 months, and by the end of 2000, it was down about 93%. And even then, it didn't stop. It just kept grinding lower and lower until the shares were worth about 1/100th of what they'd been at their peak. Some of the companies that Son had bought disappeared entirely. Webvan, an online grocery startup, wiped about 60 billion yen off the value of SoftBank's books in a single year on its way to bankruptcy in July 2001. And Asia Global Crossing, a telecommunications venture that SoftBank had put roughly $335 million into, ended up worth about 6 cents for every dollar they invested. Son's response, as all of this came down around him, was to keep buying. He kept adding internet companies to the portfolio even as the market priced his existing ones towards zero. And when Forbes profiled him at the end of 2000, he blamed newcomers, the investors who, in his words, had no passion for the internet, just a passion for making money. It was a boom without belief.
So for 3 days we were $200 billion in market cap.
For 3 days, 200
billion
in market cap.
Yeah.
And then came the crash.
Right.
And what were you after the crash, at the bottom of the crash?
$2 billion.
$2 billion. So you went from 200 to 2.
Yeah, 99% down in 1 year.
99%. And your net worth went from what to what?
From $70 billion to $600 million.
Really?
Yeah.
Son later said that in all the years since founding SoftBank, he had never experienced anything as painful as this.
So we almost went bankrupt. And somehow I survived.
SoftBank came right to the edge of bankruptcy, but that was far from the end of the line for Masayoshi Son. That 1999 meeting with a random Chinese businessman turned out to be the most valuable 6 minutes of his entire life. Now, you know me. I love a good stock market disaster as much as the next guy, but there's a very specific reason I chose to make this video at this particular moment. And I don't just mean because we're living through our own technological revolution, I mean that the mechanics and the circumstances that surround Masayoshi Son's rapid rise have startling similarities to that of the wealthiest person right now. Actually, before we go on, I do need to confess something. Masayoshi Son was never technically the richest man in the world. That's his own claim, so I obviously had to spend a bunch of hours verifying it. Not as easy of a task as it sounds. The wealth lists we have today, that update live as stock prices change, didn't exist 25 years ago. And the wealth gap between Son and Bill Gates was so close that I had to compare stock prices down to the hour, and across both the New York Stock Exchange and the Japanese one where SoftBank was listed. At the very best, you could say that Masayoshi tied Gates at roughly $84 billion for a few minutes. Let's all take a moment and hit the subscribe button in honor of all of the sleep that I've lost in the name of content. On paper, the SoftBank of 1999 looked like a venture capital firm. An incredibly successful venture capital firm. By the middle of that year, Son had spread about $1.7 billion across more than 100 internet companies. He owned about 28% of Yahoo, about 27% of E-Trade, the biggest online stockbroker, about 85% of the tech publisher ZDNet, 51% of Yahoo Japan, and pieces of GeoCities, Buy.com, and dozens of other names you've never heard of, mostly because they didn't survive long enough to matter. He invested in Yahoo way back in 1995, when it was still a tiny startup. It was a modest $2 million bet, but a few months later he came back with another $100 million for over a third of the company. It was such an absurd amount of money to pay for an internet startup at the time that even Yahoo's own co-founder, Jerry Yang, thought he'd gone crazy.
We invest $100 million to own 35%. And actually went IPO and made a great return.
By the middle of 1999, that stake alone was worth about $8.4 billion, around 80 times his money in under 4 years. Son was attempting to build what he called an internet zaibatsu, the pre-war Japanese model where one family sat at the center of a sprawling web of companies, banks, and industries, Mitsubishi and Mitsu being the famous ones. He would seed hundreds of internet companies with small checks, watch which trees actually bore fruit, and then pour everything into those, exactly like he'd done with Yahoo. By the peak, the web had grown to stakes in roughly 600 companies across 130 countries, which sounds like the exact opposite of keeping all of your eggs in one basket. Except that kind of depends on what you count as a basket. Every single one of those 600 companies was an internet company, and almost none of them made money. Their valuations were based entirely on the market's blind projections about how profitable these companies might become. Analysts at the time were pushing what they called new economy metrics, where you stopped valuing a company on its earnings and started valuing it on eyeballs. Literally how many people were looking at a website. How much traffic a website gets is obviously important, but analysts grossly overestimated how much that traffic would generate in revenue from advertising, subscriptions, or product sales. So what looked like an empire with investments in 600 different companies was really just one huge gamble. All of it, from the big Yahoo stake down to the tiniest seed checks, was a single wager on the same underlying thing, and there was nowhere in the portfolio to hide when that thing turned. And by 2001, it left Masayoshi Son in a very specific corner. Nearly everything he owned was the same dying asset. His company was drifting towards bankruptcy, and to escape it, he had to start selling. In August 2002, SoftBank announced that it had sold 11 million shares of Yahoo for about $100 million. Then in November, they sold another 17.5 million shares of Yahoo for about $294 million. Son had bought into Yahoo so early on that most of the sale proceeds were pure profit, despite selling after Yahoo stock had plunged more than 90%. The press release spelled out exactly where the money was going: the reduction of interest-bearing debt, and for the broadband business. Back in September 2001, SoftBank had launched Yahoo BB, a home internet service priced meaningfully below competing services. Their marketing strategy involved flooding the street corners and station exits with workers named the Parasol Troopers. They handed out red bags with free modems inside, and within 2.5 years, Yahoo BB was Japan's #1 broadband provider, with over 35% of the ADSL market, and real cash was finally flowing into the company again. Masayoshi Son is a master of thinking outside the box and doing whatever is necessary to succeed. At one point, while fighting for regulatory approval, he reportedly walked into Japan's telecom ministry clutching a cheap lighter and threatening to set himself on fire. He got the approval.
I had a confidence, it's when it overshoot and overshoot down. So I had a confidence that someday it will normalize.
But the craziest part of his rebound came from that 6-minute meeting in Beijing right at the top of the market. He invested into a company that was completely insignificant at the time. It was called Alibaba. Yep, Masayoshi's 6-minute meeting was with none other than Jack Ma. His $20 million investment had bought him roughly 30% of Alibaba.
Well, he had no business plan and zero revenue, but his eyes was very strong eyes, strong shining eyes. I could tell from the way he talk, the way he look at, he has a charisma, he has a leadership.
When Alibaba listed on the stock market in 2014, the stake was worth on the order of $75 billion. That's a 375,000% return, in case you were wondering. One of the greatest venture investments ever made. Still, the full climb back took a generation. SoftBank's shares didn't see their February 2000 peak again until February 2021, nearly 21 years underwater. And it wasn't until 2022 when someone finally beat Masayoshi's record for the greatest loss of wealth by an individual. Changpeng Zhao lost $86 billion, and Elon Musk lost about $200 billion. Which brings up a wild point about today's market. Son lost about $70 billion when his wealth collapsed 99%. If Elon lost 99% of his wealth, he'd blow that record out of the water. It'd be something like a $990 billion decline. And seeing something like that happening isn't entirely out of the question. Elon Musk crossed the $1 trillion net worth line on the 12th of June 2026, the day SpaceX listed on the Nasdaq. His fortune sits almost entirely in Tesla and SpaceX, both valued overwhelmingly on what they're expected to become. So if you just value those companies as the businesses they currently are, it could look pretty ugly. Tesla currently trades around 350 times its earnings, while Toyota trades at around 10 times. So if the market ever valued Tesla as a premium car maker rather than a technological bet, say 15 to 25 times earnings, the company would be worth roughly $70 to $110 billion, not $1.5 trillion. Run the same exercise on SpaceX, valuing the rocket business like a premium aerospace company, and stripping out the AI hype from XAI, and Musk lands somewhere around $100 billion of net worth, which would be a fall of roughly 85 to 90%. Or another way to look at it is that more than 80% of Musk's net worth is based on the promise of extraordinary growth achieved by his companies. For Son, it was investors dramatically overestimating the growth and value of website traffic. For Musk, it would be overestimating their robotaxi rollout, their robots, and their Mars ambitions. The big difference between the two is that a lot of the internet companies that SoftBank owned were not just overvalued, but completely worthless. Tesla and SpaceX, on the other hand, are legitimate businesses. And as staggering as it would be to see a $900 billion drop in Musk's net worth, he would still be one of, if not the richest man in the world.
I think this is like more than 10x, probably 50x bigger than .com. So even .com, there was a bubble and burst, but then right after that, the peak of the dot-com bubble, the year 2000 was not really a peak. It was like a small hill.
What an absolute full circle moment. He becomes close to the richest man on the planet, then suffers a 99% loss, then comes back, and looked at today's boom and decides it's 50 times bigger than his. Surely this time is different, right guys? Check out this playlist for another video to watch next, and thanks for watching.